In this episode, we're going to talk about corporations, how they distribute how they distribute their income, and how it's taxed, and basically the tax on dividends. All right, this is probably the last official video of the Momentum series. I may add others later, and I will certainly be adding others to Dave's Business Insights, but this will probably be the final official item in the Momentum series. Although, as I said, I may add others later. Okay, so when a business is incorporated, the company makes money. The question is, how is the company going to distribute that profit to its owners? In this case, I'm really concentrating on the owner-operator. And there's a couple of issues, or a couple of possibilities normally. One is they could pay the owner-operator a salary. There are certain rules that go with how you can pay and what you can pay, something to talk to your accountant about. But basically, you can pay a salary. It does have the advantage that it creates RSP room in Canada. Also has the advantage or disadvantage, depending how you look at it, of having CPP, your Canada Pension Plan, added to it. And that's an issue for another future video. So the other option is to pay dividends. So the company, when it makes money, can pay tax on that and then distribute out the after-tax profits in the form of dividends to its shareholders, which of course the owner-operator would be the shareholder. So I'm going to give you an example of how that works and what happens if the owner-operator gets it, and I'm going to talk about integration to show how the system is designed to not to prejudice a business decision, or maybe to make it so a business decision will be made, not a tax decision, or hopefully not a tax decision. So let's get with it. So, how are dividends taxed in Canada? In Canada, we have a system called integration, or the integration rules. These rules are normally applied to regular corporate income. That's normal corporate business income. The purpose of the integration rules is so that after you add the taxes that the corporation pays, and then pay out the money, the balance, to a shareholder, and you take the tax that the shareholder pays, the total of the two, the shareholder and the corporation, the total taxes there should come to the same amount of taxes as had the income been regular income in the hands of the shareholder in the first place. So that's why we call it integration. Well, it's not a perfect system. It actually generally works quite accurately. So let's have a look at an example. So in our example, we'll assume that the corporation has a 20% tax rate. Now, a small business will probably be lower and a larger business higher, and it will depend on the province. But in this example, we're going to assume the corporation has a 20% tax rate. We'll also assume that the corporation made $1,000, and after paying tax, it paid out the balance to the shareholder, and we'll assume one shareholder. And then we'll assume that the shareholder has a tax rate, or a marginal tax rate, of 30%. So let's take a look at how that would work. First, we look at the corporate taxes. Okay. The corporation now makes $1,000 income from operations, so it will pay taxes at 20%, which is $200. The balance left over is $800, and then the corporation will pay that $800 out to its shareholder. So far there's been $200 in taxes paid. Now let's look at the shareholder and their taxes. Okay. They receive a dividend of $800. That dividend is grossed up by 25%, which brings it back up to $1,000, and that
number is reflected as their taxable dividend income on their tax return. But they also receive a $200 dividend tax credit, which is used to reduce their taxes. So the taxpayer will then calculate their taxes, which would be 30% of the $1,000, which is $300. But then they'll have the $200 tax credit that they reduce or take off their taxes. So they'll have the 300 less 200, leaving them with $100, and that's what they'll pay, is $100. So now the corporation has paid $200, the shareholder has paid $100, and that's a total of $300. Now, had the full amount been just taxed in the shareholder's hands as regular income, they would have paid 30% on $1,000 or $300, the same amount as had they paid in total. So in other words, the government got, in one case, $200 from the corporation and $100 from the shareholder, and in the other case they got straight $300 from the shareholder, but it's the same amount in either case. So as you can see, with integration, the total tax is $300, whether parts paid by the corporation, parts paid by the shareholder, or if it's all paid by the shareholder, it's still $300. So let's look at a few notes that I think are worth covering. I should point out first, this is based on Canadian tax laws, and that's based on Canadian laws of July 2020 and the last several years for that matter. When you're watching this video, it might be different in the future because, as we pointed out before, or I pointed out before, the rules tend to change, sometimes abruptly, sometimes without much warning. Okay. The details, of course, will change depending on the actual tax rates. So I showed you an example, but of course, in your case, there will be different tax rates, but the objective will still be the same. And of course, different provinces have different rates. And I should point out that not all tax is taxed the same. In other words, investment income, things like that, income from property are not taxed the same way as normal operating income in a corporation. Now, by deferring, or by using this method, there is a deferral opportunity here though, because in the example, the company paid $200, but the last $100 wasn't paid out right away till the shareholder got the dividend. So that will hopefully encourage the business person to reinvest the money that they don't need to take out. And that can be good because it can be good for employees and it can be good for the economy. So that's part of the objective of having not all the tax taken out right away. Of course, if they do take it out, they'll pay the tax right away, but they can defer some of it by keeping it in the company and reinvesting it. And of course, that is a benefit to the whole economy. So that is basically how integration works and how dividends, or how corporate income is normally taxed in Canada.
So now you've seen the example, you've seen how the system is integrated. I do want to bring up one other thing. One might say, well, what if the shareholder is in a lower tax bracket than, say, the 20% in the example? Well, the integration will still work because, for example, if the tax in your example had the shareholder been in a 10% marginal tax bracket, then they would have paid 10% or calculated 10% tax on their $1,000 income. That's the grossed up number, which is $100. But they would still have the $200 dividend tax credit, which would reduce their income, or reduce their taxes by $200 and result in a $100 tax refund. In which case, the tax of the corporation would be $200, but the taxpayer or the shareholder would get $100 tax refund. So the net effect would be $100, same as had they just salaried out the whole income, or it had been other income of $1,000, then that taxpayer in a 10% bracket would have paid $100. So integration still works at the lower brackets too. So that's basically how the tax system works on corporations and corporate income. I hope you have found this video useful and that you'll like it and you'll share it. And don't forget to subscribe to this channel. And thanks for watching Dave's Business Insights.